Something isn't adding up in Dubai. From the outside, everything still looks exactly the same. Glass towers catching sunlight like mirrors, sales centers filled with scale models and confident voices, apartments labeled sold out before construction even begins, prices rising in a way that feels smooth, controlled, almost engineered. It looks like success. It feels like momentum. But then something slips through. Not a headline, not a press release, a statement. Quiet, specific, from someone who worked inside the system. A whistleblower describing how demand wasn't always real, how interest could be shaped, amplified, directed, and suddenly the picture changes. Because if even part of that demand was constructed, then what exactly has been holding the market up? Because real demand comes from people who need space, to live, to stay, to build a life. But what if that wasn't the full story? What if some of the pressure pushing prices higher wasn't coming from real buyers at all? And if that's true, then this isn't just a booming market. It's a system that may have been carefully balanced. And systems like that don't collapse loudly. They shift quietly until they don't hold anymore. For years, Dubai's property market sold something incredibly simple. Certainty, not just luxury, not just lifestyle, but predictable profit. Investors were told a story that made sense. Buy early, wait a little, sell higher, repeat. Developers backed this with numbers. Rental yields of 8 to 10%, constant appreciation, high demand from global buyers. Everything pointed upward. And for a while, it worked. Early investors made money. Projects sold out quickly. New developments launched before old ones were even finished. The system felt validated. And that's how belief formed. Not through promises, but through results. Each successful sale created confidence. Each profit created another investor. And over time, that confidence turned into momentum. People stopped asking how the system worked. They focused on how to enter it. Because when something appears to work consistently, questioning it feels unnecessary. And that's exactly when systems become vulnerable. But beneath that confidence, small inconsistencies began to appear. Units marked as sold, but never occupied. Buildings that looked complete, but felt empty. Apartments changing hands multiple times before anyone ever moved in. At first, these details didn't stand out. Real estate markets involve investment activity. That's normal. But the frequency started to feel different. Transactions were happening faster than real-life usage could justify. Ownership was rising, but occupancy wasn't matching it. And that gap matters, because real demand shows up in how space is used, not just how it is owned. When people need homes, they live in them, they rent them, they fill them. But when properties exist mostly on paper, moving between investors, something changes. The function shifts. And once that shift happens, the foundation begins to weaken. The data slowly began to reflect this reality. In several high-end developments, a noticeable portion of units remained empty for long periods. Rental yields started falling below what was originally promised. Some properties struggled to generate income. Others didn't generate any at all. And yet, prices continued rising. That's where the contradiction became impossible to ignore. Because in normal markets, prices follow demand. If people aren't using properties, prices adjust. But here, they didn't. They held. Sometimes they increased, which raises a different kind of question. If usage isn't driving value, then what is? Because markets don't sustain themselves on appearance. They need real pressure, real demand, real buyers who stay, not just trade. And when that pressure is missing, something else must be filling the gap. This is where the whistleblower's claims begin to make sense. Because according to insiders, demand wasn't always left to grow naturally. In many cases, it was guided. Controlled releases of units created artificial scarcity. Developers wouldn't release entire projects at once. They would release small portions, creating urgency. But limited units. Final phase. Language designed to accelerate decisions. At the same time, early sales were highlighted aggressively. Even if only a fraction of units were sold, it was presented as overwhelming demand. That perception matters, because perception influences behavior. If buyers believe others are rushing in, they move faster. They hesitate less. And that's where momentum begins. At another level, investor networks played a role. Certain groups of buyers would purchase units early, then resell them within the same network before completion. Each transaction pushed the price higher. On paper, it looked like strong demand. Multiple buyers, rising values, active market. But in reality, the same assets were circulating within a closed loop. This created movement without real expansion, activity without true demand. And as long as prices kept rising, the system held, because each new price point became a reference for the next. And that's how artificial demand works. It doesn't need to be visible. It just needs to maintain momentum. The financial structure made this even more effective. Off-plan buying allowed investors to enter with relatively small upfront payments, 10%, 20%, sometimes less. The rest would be paid later. This lowered the barrier to entry. More people could participate. Developers received early capital, which funded construction, and investors didn't need to commit fully to benefit. If prices rose during construction, they could sell before completion. Profit without long-term involvement. This created a cycle where the goal wasn't ownership. It was movement. Buy, sell, exit, repeat. And as long as enough people entered at the beginning, the system continued. But systems like this depend on one thing above all: constant entry, new buyers, new capital. Because without that, the cycle slows. And that's where the pressure begins. When fewer investors enter early, when resale becomes harder, when prices stop rising fast enough to guarantee profit, that's when the system faces its first real test. Because now investors are forced to hold. And holding reveals something important: whether the asset can generate real value, rental income, occupancy, usage. And in many cases, that value wasn't there, not at the level expected, not at the level promised, which creates friction. Because when expectations don't match reality, behavior changes. Investors hesitate, new buyers delay decisions, and momentum slows. The breakdown doesn't happen all at once. It happens gradually. Projects take longer to sell. Payment plans become more flexible. Incentives increase. Discounts appear quietly. These are signals, not of collapse, but of adjustment. But adjustment means something has changed. Because when demand is strong, incentives aren't needed. Urgency comes naturally. But when urgency needs to be created, it means something is missing. This is where the breakdown begins to show, not as a collapse, but as a shift. Projects take longer to sell out. Marketing becomes more aggressive. Incentives increase. Payment plans become more flexible. These are signs of adjustment, but they also signal that demand is no longer behaving the same way. Developers begin focusing on moving inventory rather than creating scarcity. And when that happens, the balance between supply and demand starts to change. The human impact of this shift is often overlooked. Workers in construction face slower project pipelines. Property managers deal with buildings that are only partially occupied. Maintenance costs stay the same, but revenue drops. Investors who expected quick returns find themselves holding assets longer than planned. Some can manage it, others struggle, and residents in these buildings face higher service charges because fewer occupants share the cost. These are not dramatic effects, but they are real, and they accumulate over time. There are deeper layers making this even more complex. Cost of living has increased significantly, which reduces real occupancy demand. Environmental factors, especially energy consumption in large buildings, increase operating costs. And work structures tied to employment create instability in residency. And global financial conditions, including rising interest rates, reduce investment flow. Each of these factors adds pressure, and together they create a system that is far more fragile than it appears. Globally, this pattern isn't unique. Similar dynamics have appeared in cities where rapid development outpaced real demand, where investor-driven markets created short-term growth but long-term imbalance. The difference is scale. Dubai's growth was faster, more visible, more concentrated, which makes the effects easier to see. It becomes a case study, not of failure, but of how systems behave when they are pushed to their limits. This pattern is not unique. Similar dynamics have appeared in other global markets where rapid development outpaced actual usage. The difference lies in scale and visibility. Dubai's growth was concentrated and accelerated, making the effects more noticeable. It becomes a case study, not of failure, but of how certain models behave when conditions shift. Because in the end, the real question is not whether artificial demand existed. It's how much of the system relied on it. Because if a significant portion of price growth came from engineered activity rather than real need, then the foundation changes. And when foundations change, outcomes follow. So now, when you look at Dubai's skyline, it still represents ambition, it still reflects success. But it also raises a different question. not how high it can go, but what is holding it up. Because buildings don't just depend on design, they depend on demand, real demand. So the question remains, if that demand was partially constructed, what happens when the system runs on reality alone? Does it stabilize, or does it reveal something that was always there, just hidden beneath momentum? And maybe that's the most important part of this entire story, because markets don't fail overnight. They adjust, quietly, gradually, until one day the change is no longer subtle. And by the time everyone notices, it's already happened. What do you think? Is this simply a phase in a rapidly evolving market, or the early stage of a deeper correction that hasn't fully revealed itself yet? And if you want more stories that go beyond the surface, stay with this channel. Because once you begin to see the system this way, the perspective changes. The signals become clearer, the patterns become easier to recognize. And the story is no longer just about growth. It's about what happens next, and whether the foundation is as strong as it appears. Because in markets like this, the most important changes don't arrive with warning. They arrive quietly, and by the time they become visible, they've already begun.